This is a special opportunity talking to an American college audience. Could I just quickly see how many of you have a RICP designation? I've been meaning, yes, so it's much more than half, maybe even 80% or so. So that's really helpful for this presentation because in the RICP program, we talk about three broad retirement approaches: the systematic withdrawals, the time segmentation, and the essential versus discretionary. And for a long time, I had just looked at, well, these different approaches can be viable. I don't know how people are going to choose one of them. They have these different options available. But then with my colleague on a research study that I'm going to be describing today, Alex Murguia, who actually is the first time he's seen me present in person, but he has his PhD in psychology, and so he's used to creating assessment tools to help identify characteristics of individuals. And so we worked together on this idea, me coming from the retirement planning, financial planning side, him coming from the psychology assessment side. Could we create a tool or a framework to understand how do people choose one of those broad retirement strategies that are out there? And so that's ultimately the genesis of this research. Thank you for the opportunity to walk you through that and to show you what sort of factors we found. And for me, the real highlight of doing that was seeing how well these factors interact to explain those different retirement approaches that are out there. I mentioned how in the RICP program, we look at three broad approaches. And doing this research, and I hope it will make more sense when I describe these factors, we do break one of those approaches into two. So we're going to have four viable retirement income styles for people to choose from, two that are more core, and then two that are more behavioral in nature. And I'm just looking forward to walking you through the factors that explain how people are thinking about trade-offs in retirement that ultimately can translate into a starting point for each individual. Do I want to use a systematic withdrawal approach? Do I want to use a flooring or essential versus discretionary approach? Do I want to use a bucketing or time segmentation-based approach? That's what the presentation's about. And so to get into that, now with writing the Retirement Planning Guidebook, chapter 1 of that book is the topic of today's presentation. I really view step 1 of when I get to that point where I'm thinking I may retire soon, whether it's I'm at retirement and really delayed thinking about it, or maybe 5 or 10 years from now I'm thinking to retire, suddenly it's top of mind. Step 1 of starting to make that transition towards retirement is really just understanding what your retirement income style is. Now, to do that, I want to spend a little bit of time talking about some background for retirement income. So with so many people raising their hands, having been through the RSP, I can go pretty quickly through that part, save more time at the end for Q&A, but then explain how we're talking about these four broad retirement approaches. Spend a little bit of time talking about how the risk premium through investments and risk pooling through insurance do provide two competitive viable options for people to choose from for retirement. Then talk about the research with two primary factors, four secondary factors that describe a retirement style. And then a little bit more into, well, how can we use those retirement styles to translate that into a retirement strategy more broadly? So retirement is different. And this mountain climbing analogy, probably it's in the RICP. It gets used quite a bit in the retirement space, with the idea being, if I'm climbing a mountain, what's my objective? What's the goal of climbing the mountain? Yeah, the natural answer is to get to the top. Of course, the reality is you also want to safely get back down, or it wasn't really a successful expedition. And with mountain climbing, most accidents happen on the way back down, not on the way to the top. And so that's a nice analogy for retirement, where it's likewise, if you ask someone, what's the goal of retirement planning? It might be to achieve some wealth target. Now, everyone has a different number, but if I could save this much money, I can retire. Now, the reality is that's really just the beginning. Once I leave the workforce, I now have to sustain my lifestyle from those assets that I've accumulated. And I have to do that over an unknown time horizon and in the face of new risks. And so risk changes in retirement, getting down the mountain, sustaining my lifestyle over an unknown time horizon in retirement, really is potentially more complicated than climbing the mountain, getting to the top of the mountain and accumulating assets to meet my wealth target goals. So in that regard, I like to refer to Harry Markowitz as the founder of retirement income planning. He developed modern portfolio theory in the 1950s. He won a Nobel Prize for it in 1990. And after winning the Nobel Prize, this is a quote from 1991, he was asked to write an article, how does modern portfolio theory apply to household investors? And his answer was he never thought about it before. This is after he won the Nobel Prize, and after already with ERISA, modern portfolio theory is the framework for building household portfolios in ERISA-based plans since the 1970s. But he had never thought about it before. And after reflecting on it for an evening, he recognized modern portfolio theory wasn't intended for household investors. He had developed it for large institutions, mutual fund companies. And there's a lot of differences. I mean, we could argue pre-retirement, it's a better approximation. But when we talk about retirement, a couple key differences. So modern portfolio theory, he could develop mathematical equations to define asset allocation. And he could do that because the basic problem he's solving only involved assets. How do I grow a pot of assets? It's an asset-only model. There's no liability that I'm trying to fund. Whereas the household's retirement income problem is I have to use assets to fund my liabilities in retirement, to fund my expenses in retirement. Also, modern portfolio theory, it's a single time period model. It's just over the next time horizon, how do I choose asset allocation to seek the highest risk-adjusted return subject to my risk tolerance for dealing with short-term market volatility? Households have to fund a liability over an unknown time horizon. So he noted we really have to think about investing for households or individuals differently from investing for institutions like mutual fund companies. And this was 1991. This is before Monte Carlo became prevalent. Today, most planning software, you run Monte Carlo simulations. But he predicted all that. He said you can't solve these problems with mathematical equations. The best you can really do is recognize there's so many variables at work, each of which is facing a different degree of randomness. We have to just run these simulations. He called it game of life simulations. See how everything fits together. See how different retirement strategies might work. Or he's saying really for the household investing problem, it has to be based on these game of life simulations. You can't just write mathematical equations to solve the household's investing problem. So for me, that's the birth of retirement income, that we really need to carve out retirement income as something distinct from the pre-retirement wealth accumulation phase. Now, these are the risks of retirement, and longevity risk is on top. It's not named properly because it's a good thing. It means living a long time. If I live a long time, that's a great outcome. It's just leave it to an economist to point out the financial costs of living a long time. The longer someone lives, the more expensive their retirement. Every year of retirement is another year of their budget they need to fund, and so the cost of retirement is growing with the length of retirement. So how long do I need to plan for? And then with a longer retirement, there's also time for these other types of risks to manifest and become a problem. Macroeconomic market volatility, and when I'm saving for retirement, a market downturn can actually help me if I'm adding new savings. I get to buy more shares. Post-retirement, we talk about the sequence of returns risk, where if there's a market downturn and I have to sell assets to meet a spending goal, I have to sell more shares to meet that goal. That digs a hole for my portfolio so that even if the market recovers, my portfolio won't enjoy a full recovery. And so market volatility has a bigger impact post-retirement. Then we have inflation eating away at the purchasing power of assets over time. And then we have these different personal spending shocks, which of course exist pre-retirement as well, but it just becomes more of an issue when you have to rely on your accumulated assets to fund healthcare expenses, long-term care, the possibility of a significant long-term care event, helping adult family members, other types of spending shocks that are really, you kind of may be aware they could happen, but they weren't part of your baseline retirement budget. And so the question becomes, how much do I need to have set aside to deal with these possible contingencies where I don't know exactly what it's going to cost? How do I plan for those types of spending shocks as well? Now, this is the part where I probably can fly through this because we've introduced the different retirement risks. Just longevity risk is illustrated here. If I'm worried about outliving my money, I have to decide what sort of time horizon to plan for. And if I'm going to self-manage that risk, this question becomes really important. If I'm 65 years old and I'm thinking, well, my life expectancy may be 87, but I don't necessarily just want to plan to 87 because if I run out of money at 87, there's still a 50% chance I'm still alive. Well, how far out do I need to go? A lot of the basic guidelines around retirement, kind of the concept of the 4% rule was 65-year-olds planning to 95. Well, then the risk is, what if I live to 96? And those are not insignificant odds, but this is the general question of longevity risk. If I'm going to self-manage, I have to spend less to stretch those assets out for longer in retirement. And I have to decide going the other way, how do I strike the balance here? Do I spend less so that I don't run out, but then I might miss out on the opportunity to really enjoy a full lifestyle in retirement? Or do I spend more and enjoy my early retirement years, but with the risk that I might then outlive my assets in retirement? And it's a similar issue with the market risk. So when Bill Bengen created the 4% rule back in the 1990s, he was responding to the idea market volatility may have a bigger impact than appreciated. That was still the days when people were plugging average return numbers into spreadsheets and calculating sustainable spending on that. And so he looked at, well, if you got the average historical market return for a portfolio with a 50-50 allocation going back to the 1920s, you could have used a 6.3% initial withdrawal rate, increased that spending for inflation, and it's that cyan curve spending your portfolio down to 0 after 30 years. But if you introduce the actual market volatility of historical sequences, what if I got the market returns from 1926 through 1955, a 30-year horizon, 1927 through 1956, and so on? There's a lot of volatility in the outcome. And in about half of the simulations, I would run out before 30 years. The other half, I would still have money left after 30 years. Using an average return corresponds to a 50% chance for success. So he's looking at, well, how do we develop a higher probability of success based on the historical data? Let's lower that distribution rate. That's going to pull up all the wealth curves. And then 4% was ultimately the answer to the question of how low did that distribution rate need to go so that that worst case market outcome lasted, the money lasted for at least 30 years. And in any other scenario, you would have had money left. So it's developing a conservative approach to spending to help manage that type of market volatility risk in retirement as well. Okay, so that's background on retirement. Now there are different viable retirement strategies. It is still the Wild West, and part of that is there's no standardized terminology on what to call any of these. So we're going to develop a set of names just to consistently use from that point forward. But let's go through 4 broad retirement approaches that are available to individual consumers. The first one we'll call total returns. In the RICP, it's called systematic withdrawals. It's the approach that's most closely aligned to the pre-retirement wealth accumulation phase. Build a diversified portfolio, invest for growth, it's modern portfolio theory, seek the highest risk-adjusted returns you feel comfortable with, and then systematically spend from that portfolio in retirement. And if you can use a variable spending strategy, that will help manage the sequence of returns risk in that retirement with that diversified investment portfolio. So this will be one of the core approaches. We're going to have 2 core approaches and 2 behavioral approaches. So this is a core approach. Its behavioral cousin is time segmentation, also commonly known as bucketing. This is going to be more of an investing-based approach, but it's treating asset allocation just from a mental accounting basis differently. With a total return portfolio, if I decide to be 60-40 stocks and bonds, bonds are my volatility reducer. I choose the 40% bond allocation to help reduce the overall volatility of the portfolio compared to a higher stock allocation. But stocks are intended to provide the growth of the portfolio over time. With time segmentation, it's more about returning to the basics of what are different assets used for. Bonds are fixed income assets. So with short-term buckets, let's fill those with bonds to cover upcoming expenses without having to worry about the volatility for those assets. And with the growth assets, the stocks and so forth, we put those into long-term buckets, earmarked more to provide growth over time. And then we will need to have a way to draw from the long-term buckets to replenish the short-term buckets as we go along. But it's a behavioral framing for asset allocation that for advocates of this approach, they say it's easier for individuals to understand. And kind of the behavioral idea is when we're trying to get someone to stay the course and not panic during periods of market volatility, that can be harder with a total return approach. The idea with time segmentation is I've got the short-term bucket. I don't have to worry about selling stocks for X number of years, so I don't have to panic. I'll stay the course. I'll give my portfolio a chance to recover, and that makes it easier for me to manage that market volatility in retirement. So this is a behavioral cousin of total returns meant to provide more of a foundation for how to manage investments from a behavioral foundation. Then the third approach, we'll call income protection. In the RICP, I think we generally use the name essential versus discretionary. Sometimes it's also called the flooring approach, or first build a floor and then expose to upside. It's the idea of before I start to invest for growth, I want to make sure I have a foundation of reliable income to last over my lifetime. Once that's in place, then I can invest on top of that for more discretionary goals. And so I want a floor of lifetime-oriented income that includes Social Security, that includes pensions, that at some degree can include holding individual bonds to maturity. But then the idea is if there's a gap, if I'd like to have more reliable income than what's already available, I might look more towards a commercial annuity product to fill that gap. And then with that foundation in place, I can feel more comfortable and I have the risk capacity to invest on top of that for my discretionary goals where there may be more flexibility. But I don't want to take that sort of market risk when it comes to my essential spending. So that's the third approach. And we're going to, now we have the three main RICP approaches, we're going to give it a behavioral cousin. So risk-wrap is the behavioral cousin of income protection. And I hope this will make more sense as I work through the factors that help to describe retirement strategies. But the idea here is going to be I still want an underlying foundation of reliable lifetime income, but I may be more willing to take market risk for that income. But I may like some sort of guardrail around that. And I'll get to talking more about where annuities fit and so forth. But the behavioral idea here is you can get the same outcome as a risk-wrap strategy by holding stocks and income annuities. But behaviorally, that can be a struggle. And so since the 1990s, financial services has developed the idea of deferred annuities with lifetime income benefits that will give access to the underlying assets, that will provide growth opportunities, but that still lay in a foundation or a floor of lifetime income so that even you're taking market risk, but even if markets don't cooperate, you still have guardrails around exactly how much income you'll be able to get, and you do have a lifetime foundation for income. So this is going to be a behavioral cousin looking for benefits from lifetime income protections, but with more flexibility than a pure simple income annuity could provide. So and to be clear about that, any of those approaches are viable. There's no right answer. Everyone may think about these matters differently and find they're more comfortable with one approach or another. But I do want to emphasize people do have options. And another way to frame that is we can think about three broad ways to fund retirement. Method one, I build a bond ladder. Like if I'm trying to plan for 30 years of retirement income, I can use TIPS, Treasury Inflation Protected Securities, to get 30 years of inflation-adjusted lifetime income. And then the yield curve tells me what I can spend. TIPS yields are pretty good right now. It's in that 2.4, 2.3% real range with inflation on top of that. That can support an initial distribution rate in the neighborhood of 4.6%. So better than the 4% rule. Now with that, if I build a 30-year TIPS ladder, I'm also spending maturing face values as part of meeting that spending goal. So at the end of 30 years, I don't have any money left. The yield curve tells me exactly how much I can spend for exactly the time horizon I plan for, but with no possibility to spend beyond that. Then retirees have two options to potentially spend more than that. Option one would be building a diversified investment portfolio, seeking risk premium from the stock market. The idea of capital gains, that stocks are expected to outperform bonds over reasonable holding periods, and I can draw from that to sustain a higher level of spending through a diversified investment portfolio compared to what I could get with bonds by themselves. And so a diversified investment portfolio, there's no guarantee I'll get that risk premium, but if I'm comfortable that generally speaking historically I could rely on that risk premium, that will allow me to amortize that upside and spend at a higher level throughout my retirement. The third option would be the insurance-based story. Thinking in terms of a simple income annuity, for the insurance company, they're effectively building, mostly speaking, a bond portfolio. So I have, just like with my bond ladder, I have return of premium through the return of face values, like return of my premium from the annuity, interest earned on the insurance company's general account, that becomes part of the payout rate quoted to me. But then I have a third source of spending compared to bonds, which is the mortality credits or longevity credits, that the insurance company can use the law of large numbers to pay everyone as though they'll live to their life expectancy, knowing those who don't live as long and therefore don't have as much of an expensive of a retirement will help to subsidize those who live longer and do have a more expensive retirement. but that will allow for a higher standard of living for everyone in the risk pool relative to what I could do with a bond ladder. So the annuity can support more spending than bonds for a longer term retirement horizon that I may be worried I need to plan for, just like a diversified investment portfolio can provide more spending than bonds, assuming I do receive the risk premium. So people have legitimate and valid options here about which direction they want to go. Are they comfortable with the risk premium, or would they prefer relying more on the risk pooling aspect of insurance? And that's background, now getting into the research behind understanding, well, how do people make these decisions? And that's been my concern all along. I know a good financial planner is going to match themselves appropriately with clients so that they have the strategies in alignment. Not everyone works with financial planners. How does the general population choose a retirement approach? They may not know they have options. I use the analogy of they turn on the car radio. They probably have to go into the AM dial to hear these types of commercials. But what are they listening to? Is it the commercial about, I hate annuities and so should you? And so therefore, if you buy my really expensive portfolio, if you have at least $500,000, you can enjoy your retirement. That's pitching a total returns approach. Or maybe they flip to another station, and it's how a fixed index annuity solves every problem under the sun with principal protection, market growth, liquidity, all in one convenient package. Any advocate for an approach will make it sound good, and ultimately any of these approaches are viable, but did I get to choose the approach that was right for me, or is it just random how I happened upon hearing about a particular approach and ended up with that, even if it wasn't the right approach for me? So that motivated the research project. And again, with Alex's background in psychology, he wrote like 900 questions. What we did, we read as much as we could about retirement for consumers, for advisors, to identify trade-offs where people have to make some sort of decision. Do I do this or do I do that? And then so at one point there were 900 questions. Then we have the retirement researcher community, which is the online, like our do-it-yourself investor community, who very kindly would take 300 question surveys to help us build the foundation for doing a statistical analysis to see how do these different questions interact. Can we identify factors, and can we use statistical analysis to identify factors that explain how people think about retirement income? And the answer was...
actually answered all 300 questions.
Well, in those early stages, yeah, do you know, Alex? I mean, oh yeah, the original retirement researchers say, I think it was 1,400 total, yeah, maybe...
300. The 900 probably at 4,000.
Yeah, you would have given and so that includes advisors as well. So we have this mix of advisors and do-it-yourself. If your hobby is personal finance and retirement, I think a lot of people are just excited and it's but very, very helpful. so yeah, but that laid the foundation. We have published several peer-reviewed articles about this, and let me get into more of what we learned, but also refer to some aggregate results for the population. So we have been able to complete a number of national studies with different organizations, 5 studies listed here. I feel like there's another one, but that give us about 10,000 observations representative of the broader US population. Oh, the 6th one was the retirement researcher, but it's not a nationally representative population. These 5 studies gave us nationally representative populations to be able to understand retirement income styles. And so what we learned from that, there are 2 primary factors that the data points to as being relevant, really incredibly relevant to people's decision making. And there's 4 secondary factors. And I'll walk through all 6 of these factors because it really helps to tell a strong story about these retirement styles. But at the end of the day, if like a person's taking this, they really only need the 2 primary factors. They don't have to work through all the additional questions. But all this information works together based on how people score along the spectrum for each of these factors. It's going to translate into a retirement strategy. So let me walk through what those factors are. The 2 primary factors are going to be probability-based versus safety first, and optionality versus commitment. So I do need to emphasize there's no right answers here. People are going to, it's a trade-off. They have to decide which way they go. And so they answer these questions. If they're and these questions all relate to what kind of assets do I want backing my essential spending in retirement? If I lean towards probability-based, there's a sense that I'm fundamentally comfortable relying on market growth to fund my essential expenses, in addition to all my retirement goals, effectively. But I believe in the idea of the risk premium, that stocks are expected to outperform bonds, and that will probably work. A diversified portfolio will probably work with a high probability of success. If I run the financial plan and it gives me a 90% success rate, I'm comfortable moving forward with that kind of an approach. So that would be more of a probability-based answer. Safety first, and to be clear, this is not anything to do with market forecasting. One of the studies we did, we asked the question, what do you expect the stock market to do over the next 10 years? Answers ranging from averaging more than 10% a year to averaging negative returns on average over the next 10 years. You might think the probability-based person would be more optimistic with a higher stock market forecast, safety first, more pessimistic. There's no relationship there. This has nothing to do with, do I think the markets are going to perform well? I could be safety first and still think the stock market is going to average more than 10% a year. But what's going on here is, I know I get one chance at retirement, one opportunity for success, and I really would prefer to have a plan with some sort of contractual protection behind it. Now, there's nothing that's truly 100% safe in any circumstance, but when it comes to compared to unknown market outcomes, I really value having some sort of contractual protection backing the asset, funding my essential expenses in retirement. Now, that could include holding individual bonds to maturity, but you're not getting any sort of premium from that. Or it could use using the power of risk pooling and actuarial science with annuities and insurance to support a higher level of spending than the bonds. And so this is creating a trade-off here. When it comes to my essential spending, am I comfortable relying on market growth, or would I prefer some sort of contractual protection backing those assets, both of which can potentially support a higher level of spending than simply using bonds throughout retirement? Now, the other primary factor is optionality versus commitment. And so this is about, when I'm thinking in terms of my retirement assets, optionality is, I want flexibility for everything. I really value flexibility. I want to be able to see my statements. I want to be able to make changes, respond to new situations. And also, when we talk about like flexibility with optionality, we're going to see a sense of, I also don't necessarily have fixed expenses that I absolutely need to fund. There's a sense of flexibility with how much I'm going to spend, but I value having flexibility. I value making changes, and that's the optionality orientation. Comparing that to a commitment orientation, there's a sense of, if I can find something that will solve my lifetime need, I'm okay committing a portion of my assets to that, to lock that in, to take it off my to-do list, to not have to worry about it as much. Then there's some nuances here around recognizing cognitive decline can be an issue in advanced stages, or I may not be around to make decisions for my family. So by committing to a strategy and locking it in, I'm helping to protect myself and my family from either the cognitive decline that I could experience or just not being around anymore. But committing to a strategy to meet those essential expenses makes me feel much more comfortable with retirement. Now, it doesn't mean I don't have any optionality anywhere, but at least for a portion of my assets, I'm willing to give up some of that flexibility to get that sort of commitment to a strategy that can work over my lifetime. Now, I almost have to say this with every slide. There's no right answer here. That's simply, how do you view this trade-off? Each person's going to have a different answer for it. Now, those are the primary factors. Let me just also mention the secondary factors as we're really diving deep into what you should be thinking about with clients when it comes to their retirement plans, or thinking about your own situation as well. The secondary factors will help to refine the story. And there's 4 of them. The first is, to the extent that I'm thinking about having a floor of income for reliable expenses, do I view it more as time-based or perpetual? So this, a good analogy here is, I'm going to ride the railroad, the train down the railroad track. If I have a time-based approach, I don't have to have the whole track built before I start the train. As long as there's someone ahead of the train building out rung by rung so that I've got at least a few rungs ahead of me as I move along, I'm okay. I can start going down the train track before the whole track has been built. And that's more the idea of a time segmentation approach. I want to have my expenses for the next few years covered, but I don't necessarily have to build out a full lifetime income floor from the beginning. And that can be contrasted to perpetual flooring, which is, no, I'm not going to start the train down the track until the whole track is completed. I don't want to be relying on building that out piece by piece. I want the lifetime income floor fully in place before I start the train down the track. And so that would be more of a perspective of, if I need a floor, I want it to be more perpetual in nature. The next secondary factor is true liquidity versus technical liquidity. Now, technical liquidity, it's easier to start. Usually I explain the left-hand side first, but it's easier to start with technical liquidity because that's how people think about liquidity, especially in an accumulation mindset. Is the asset liquid? I have $1 million in a brokerage account. That has technical liquidity. That's what liquidity, that's our standard meaning of liquidity. Now, to understand the distinction from true liquidity, let's suppose I have that $1 million in a brokerage account. I've read the research on the 4% rule, and I think that's a pretty reasonable, safe withdrawal rate. And I have a goal to spend $40,000 a year in retirement, plus inflation as I go through a potentially 30-year time horizon in retirement. $1 million in a brokerage account, $40,000 plus inflation spending goal. Do I have any liquidity? Yeah, so that the no answer is getting at the true liquidity concept. Technically, yes, the brokerage account is liquid. I could spend it on whatever I want, but in the meaningful sense of my retirement, no, that asset's not liquid. It's earmarked for that future spending goal. And if I use it on something else, I jeopardize my ability to meet that future spending goal. Whereas true liquidity, there's a sense of I want to earmark assets for different liabilities, and I don't view an asset as being liquid if it's earmarked for something else. I only view an asset as liquid if it's truly available to be used for anything. Now, I think this kind of thought process explains partly the retirement consumption puzzle that's been researched and that's out there. The idea that people who have assets in retirement sometimes seem like they have a really conservative spending rate. They could spend much more, but for some reason they don't. I think one potential explanation is there's this idea of they're worried about long-term care, or they're worried about these big potential expenses. And if they're in a technical liquidity frame, they don't really have a way to know how much can I spend for enjoyment in retirement, how much do I need to set aside for the unexpected. Whereas if they could think in a true liquidity frame, that might make it easier. Now that leads us to a simple income annuity. Income annuities have no technical liquidity. It's an irreversible commitment to a monthly payment for the rest of one's life. So you're not going to get technical liquidity. The annuity is not giving you true liquidity itself. However, it may set up for other assets to become the source of true liquidity. If I can earmark something to meet my retirement liability, my ongoing retirement expenses, then other assets in my portfolio are no longer sourced to meet that spending need as well, and they become a true source of liquidity for the financial plan. And so if I have a true liquidity mindset, there's more a sense of I want to earmark assets for different purposes. If I'm worried about long-term care, I want to be able to say, here's an asset set aside, not needed for other goals, that's available for potential long-term care needs. Whereas if I have a technical liquidity mindset, there's more a sense of I'm going to have a big pot of assets that I'll draw from as needed. And it's the same assets I'll draw from for expenses. If I have a long-term care need, I'll draw for that. But I'm okay just thinking in terms of having a pot of liquid assets, again, versus true liquidity. I want to earmark different assets for different purposes. And I only view an asset as liquid if it's not earmarked for something else. The next one is, do I have an accumulation mindset in retirement or a distribution mindset in retirement? So the accumulation mindset, it means I haven't really changed that much pre and post-retirement. Pre-retirement, we're using modern portfolio theory to build a diversified portfolio to seek the highest risk-adjusted returns for the portfolio over time. We want to maximize portfolio returns. We're not worried about funding a liability because we fund our expenses through our work income. Post-retirement, do we maintain that mindset? And if we do, there's a sense of, I may not really view that as a fixed liability I'm trying to fund. I'm going to use a flexible spending strategy. My focus is more on still maximizing portfolio returns. So that would be accumulation. Distribution is, Now, post-retirement, I'm more focused on having a predictable stream of income over my retirement. If that means sacrificing some portfolio returns, that's fine. My focus is on predictable income, not on maximizing portfolio returns. So do I have the accumulation or a distribution mindset? And then the final factor is front-loading versus back-loading. Now, occasionally in the consumer media, there'll be a story about a survey done that shows Americans are more worried about running out of money than they are about dying. So if someone expresses that, that's the backloading preference. This is, I'm worried about outliving my money. The front-loading preference is, I know I'm alive and healthy today. I don't know if I'm going to live into my 90s or not. I don't want to live into my 90s but have lived a really kind of low-level lifestyle and missed out on all these opportunities. I'd rather maximize my lifestyle and enjoy my retirement today while I know I'm alive and healthy. And if that means I have to make cuts later on, if the possibility I'm still around anyway, I'm willing to make such cuts. That's the front-loading preference. The back-loading preference, there's just a sense of, it's not that you're sacrificing everything today, but you're willing to maintain a more stable lifestyle throughout retirement just to better protect the possibility that if I do live to an advanced age, I'm not going to deplete my resources. I'm not going to have to rely on only Social Security or whatever the case may be. I'm willing to manage that lifestyle throughout retirement in a more level type manner. So front-loading, let's enjoy the retirement while we know we can. Back-loading, now let's make sure we don't outlive our assets later in retirement. So we have these 6 factors. They're all independent factors. They do have some correlations, though, so that, in particular, if I'm probability-based, I'm more likely to also have optionality as my orientation. If I'm safety-first, I'm more likely to be commitment-oriented. And then with the secondary factors, we see those correlations as well. So on this chart, I'm building a matrix. I'm putting probability-based on the right, safety-first on the left, optionality on top, and commitment on the bottom. And then I'm also showing where those secondary factors correlate as well. Not that it's always going to show up exactly that way, but the odds are, if I have probability-based and optionality as an orientation, I'm probably also going to be accumulation-focused and having time-based flooring preferences, and so on and so forth. And so we have this matrix. We have different combinations of these factors. And this was the real aha for me, was just seeing how well this explains those retirement strategies that I mentioned earlier. Okay, so here, all I'm doing is adding the names of those retirement approaches. And let's take a quick tour of this. We'll start in the upper right-hand corner. I'm probability-based, so I'm comfortable relying on the markets. I have an optionality orientation. I want flexibility for my assets. That explains the total return investing approach. I'm going to build a diversified portfolio and spend from it as needed to meet my expenses. And with those secondary characteristics, I have a front-loading preference. I want to maximize my lifestyle today. Looking for that market growth and enjoying spending from that market growth to enjoy a higher standard of living. I have the accumulation mindset. I'm not worried about predictable income in the same way that someone with a distribution mindset would. If markets do well, I'll spend more. If markets do poorly, I'll spend less. And I'm okay managing that kind of flexibility for my spending. Time-based flooring, which I don't need that lifetime perpetual floor. And then technical liquidity. I value the liquidity of a brokerage account. So that's the total return in the upper right. And then we'll go to the lower left, the other core strategy. In the lower left, this is safety first. I want contractual protections for the assets backing my basic expenses. Commitment orientation. I'm comfortable committing to something that will solve my lifetime need. Well, that's income protection. I want a floor of protected, reliable lifetime income to cover my basic expenses before I invest on top of that for discretionary goals. With the secondary factors, the true liquidity shows up there. I'm earmarking different assets for different purposes, and I don't view an asset as liquid unless it's unfettered from having to support some other liability on my balance sheet. Distribution mindset. I value having predictable income, even if that means sacrificing some market growth. Perpetual flooring. If I think about having a floor, I want it to be on a lifetime basis, not building out piecemeal, piece by piece as I go along. And backloading. I am more worried about outliving my money, so I value commitment to something that will support for my lifetime need. Now, those are the 2 core strategies, and we see all the secondary factors aligned there. But let's also visit the two behavioral strategies. Upper left, and the secondary factors don't play as much role in these next two. But in the upper left, it's safety first. I want protections, but also optionality. I want the flexibility to make changes. There can be a conflict there. How do I get protections? How do I get contractual protections and still maintain flexibility? Well, I think that's where the financial planning community intuitively figured that out in the 1980s with a bucketing-based approach. I get protections with short-term buckets, providing fixed income for upcoming expenses, and I get the optionality from my long-term buckets, providing the growth and the flexibility and the ability to make changes as I move along. And then in the lower right, so this is risk wrap. This is going to be the probability-based. I'm comfortable relying on market growth. Commitment orientation. I'm also comfortable committing to something that will solve my lifetime need. There is that backloading here that I am more worried about outliving my money. And then also when we think about, so it's kind of the punchline that we're heading towards, the behavioral solution would be a variable annuity with a living benefit. Gives you that probability-based exposure, the commitment to lifetime income through the living benefit. The technical liquidity is always part of the marketing there. I don't have to commit to that on a lifetime basis. The underlying contract value, I can pull it back out if I want. I would sacrifice the lifetime income guarantee, but I have technical liquidity, and that's one of the big kind of marketing points that you see there. And then the backloading as well, that by having that living benefit, I have that lifetime income floor available to me. So that's the risk wrap approach. Now, in those national studies, for a couple of the studies did look at a younger age group as well, but mostly the general age groups we're looking at are traditional, leaning towards retirement, between 50 and 80, that type of age range. We consistently find the distribution, about 35% of the population, a representative sample of Americans, total returns. Somewhere around there, usually a bit higher perhaps, so 36% income protection, and then the remainder are split between time segmentation and risk wrap. Now, one question that comes up here quite a bit is, this is the population at large. Are there any characteristics of people that we can identify that would let us dive a little deeper? Mostly when you look at someone, you can't predict their retirement style, so a lot of the characteristics have no relationship, but there are two. Net worth is one. For individuals with higher net worths, they too tend to tilt more towards total returns, so it's more the upper 40% are total returns. Why is that? We think the most reasonable explanation is probably more, it's endogeneity, that you only get to have a high net worth by taking risks. And so if those risks worked out, you end up with a higher net worth. And just because you're more of a risk taker to begin with, higher net worth individuals will exhibit more of a total return approach. And then lower net worth, it leans more income protection. And the other one is gender, that we do see pretty significant evidence. For men, the total returns is like 48%, getting closer to the 50%. Whereas for women, it's the income protection. So when you talk about a couple, with the two different gender couple, there's 6 different possible combinations of retirement styles, and no one's getting becoming a partnership without with thinking about this first. So it's going to be somewhat random about what these styles are, but the most typical case, because that's where more people are, you have like the total return husband and the income protection wife. And they have to then navigate how do they build a strategy around that. And that can lead to some interesting conversations. But everyone's going to have their own style. And then in a couple, there may be 2 different styles to navigate. And that's generally how it looks at the population at large, with those 2, net worth and gender, are where we can see tilting away from these population at large type numbers. Now, that being said, then you can build strategies around this. And so investments have a role in every retirement income plan. That's where when we start getting into the debate about, is there one approach that's better than another? The income protection is not rejecting investments. It's just before I start investing, I want to have a floor of reliable income in place. Then I have the risk capacity to invest on top of that more confidently for more discretionary goals. With the total returns in the upper right, it's more, not just the diversified portfolio for everything is fine. Time segmentation is structuring the investments more with a bond ladder plus long-term growth buckets. And then, well, like I was saying, both for income protection and risk wrap, The investment piece is more for lifestyle goals, for the discretionary goals on top of the essential expenses. But this also opens up an interesting conversation around annuities. And so there's a lot of acronyms on this slide. And for those who aren't versed in what all the acronyms are, ultimately this can provide a shortcut to start to see where different annuities can play a role. But the basic idea will be, if I'm on the top half of the matrix, I'm not going to have as many conversations about annuities. And with total returns especially, there's not going to be a lot of conversations around annuities. At the margins, maybe a low-cost investment-only variable annuity for the tax deferral, if I have tax-inefficient asset classes, and if the fees are low enough, might look at that. Maybe there's a role for the registered index-linked annuity as part of the asset allocation. But not a lot of talk about annuities for total returns. With time segmentation, well, deferred annuities provide tax deferral. So if I'm comparing, do I want this in a taxable bond portfolio, or do I want to have a deferred fixed annuity or a multi-year guaranteed annuity or even a fixed index annuity, something to fund those short-term buckets, I want to look at, well, what's going to give me the best opportunity on an after-tax basis? And so I may look at annuities for that sort of short-term fixed income objective. Then it's the bottom half of the matrix where a conversation around annuities for lifetime income would be more relevant. And the basic way I've structured this from left to right here would be, on the left, income protection, I'm looking for the strongest guarantees even if markets don't do well. And so that's generally in the fixed annuity world, whether it's the single premium immediate annuity, a deferred income annuity, whether it's a fixed index annuity with a living benefit that might even have competitive payout rates with SPIAs and DIAs. I'm looking for what's going to give me the most income even if markets don't do well, because I really want to allocate and know exactly what I have to set aside with that true liquidity concept in place to cover that spending goal in retirement, freeing up those other assets. As I move to the right into the risk wrap, then I may look more at annuities that generally the payout rate schedule might be less than with the fixed annuity, but there's growth opportunities and step-up opportunities. And if markets do perform decently in my retirement, I can step up the level of income and potentially have a higher guaranteed income on average throughout that retirement. And so variable annuities with living benefits, whether it's the traditional VA with the sub-accounts or now the registered index-linked annuity that has the downside risk exposures, but in exchange has more upside growth potential as well with a living benefit attached to that. And so for this slide, this is not from a national study, because not everyone could answer this question. This is one of the questions from our initial retirement researcher study. We asked, do you own or do you plan to own an annuity for lifetime income? So the typical person may not really be able to answer what exactly that question is getting at. But the retirement researcher community, this is the percentage of people who said yes, as broken down by how they scored on these retirement income factors. And so we see this predictive idea that if your total returns, you're not interested in annuities. And that makes sense based on your preferences. You're not trying to solve for having a predictable income stream. You really value the flexibility of investments. You're comfortable relying on the market growth. You want to maximize your risk-adjusted returns. There's not a role for annuities. But as you go in the lower left-hand direction, the percentage of people saying yes increases in quite a dramatic way. And these folks know what they're doing. Sometimes with income protection, you went into a career that gave you a big pension. So between Social Security and pensions and things, you may not need to buy a commercial annuity. So even if you are income protection, you've already solved it with your defined benefit pension. But still, we get to the extreme lower left, 61% of people saying, yes, I own or plan to purchase an annuity for lifetime income in retirement. So we see that element of predictive power here as well. And then one last general comment before I wrap up. I call this the 4 L's, the financial goals of retirement, but kind of as Alex pointed out, well, these goals could also be concerns. Am I concerned about meeting those goals? And so longevity, am I concerned about my ability to meet my essential expenses no matter how long I live? Lifestyle, am I concerned about missing out and not fully maximizing my lifestyle in the early years of retirement? Legacy is self-explanatory. Am I concerned about leaving a legacy? And then liquidity, am I concerned about having reserves to deal with unexpected expenses? And we broke that down between health-related expenses, including long-term care, and just other replacing a roof and that type of general spending shock as well. But am I concerned about having reserves to deal especially with those health-related spending shocks. And we looked at how well these factors can explain concerns and also compared that to the traditional risk tolerance questionnaire. The risk tolerance questionnaires, they're a product of the accumulation phase. They're a representation of modern portfolio theory. It's build a diversified portfolio. Generally, you'd like to be 100% stocks, except your ability to stomach short-term market volatility might prevent that. So what's the highest stock allocation you can stomach in terms of your tolerance for short-term market volatility? That idea of risk tolerance it links to lifestyle. The more risk tolerant I am, the more I'm worried about maximizing my lifestyle in retirement. And that makes sense. But it does not link to concerns that people have about outliving their money. It does not link to concerns people have about having reserves for the unexpected in retirement, whereas these retirement factors do. So what we see is if I have more of a commitment orientation, I'm more worried about, am I going to outlive my money? I don't want to be in the position of outliving my assets in retirement. If I have more of a safety, and so that's on the bottom. If I have more of a safety first orientation, so I'm more on the left, I have more concerns about having reserves to meet those unexpected expenses in retirement. And that ties into that true liquidity mindset too. The optionality orientation, so on top of the matrix, they are more concerned about lifestyle, and the strength of that relationship is actually stronger than the risk tolerance measures relationship. And then also on top of the matrix with the optionality orientation, those individuals do tend to be more worried about leaving a legacy as well. So when it comes to retirement concerns, we think these factors are really helpful in providing that initial starting point for thinking about a retirement approach and for understanding also what sort of things are concerning people when it comes to building their retirement income plan. And so it lays the foundation for building the retirement approach. This is the RIO map, retirement income optimization. Those concerns or goals map into liabilities on the right, and then we're positioning assets to fund those goals. And so where this idea of retirement income styles comes into play is, do I have enough reliable income to meet my essential expenses? Say I've got Social Security bringing in $40,000 a year. I've identified fixed expenses of $60,000. I have a $20,000 shortfall there. What do I do about that? If I'm total returns, I'm not worried about that shortfall. I'm worried more about if I add reliable income to diversified portfolio, is that enough to cover everything? And I'll draw from the diversified portfolio to fill that gap because I don't really even necessarily think about essential expenses as distinct from my overall lifestyle need. Whereas if I have one of the other styles and I have that gap, then this points to how I might like to solve it. With time segmentation, I want a short-term fixed income bucket to fill that gap for the next few years. With income protection, I want lifetime income, probably more on the fixed annuity side. And with risk wrap, I would like lifetime income protections, probably looking more on the variable annuity side. But it provides a framework for them thinking when there's a need, what sort of approach is going to resonate best to fill that need. And so we do need to think about retirement differently from pre-retirement. That's the whole purpose of the conference. I think that message is pretty clear. There are different viable approaches people have. The right approach for someone does depend on their personal style. We think that this framework provides a starting point for having those discussions about strategy. And advisors ultimately have been arguing this for years. Advisors who are comfortable working with these different tools can ultimately craft approaches to satisfy everyone they meet and don't have to worry about the closed losses on, well, if I'm a total return advisor and this is an income protection person, or maybe I'm talking to a couple and one of them's income protection, I don't have a way to fill that need they have to have reliable income and to not have to rely on market exposure to meet their essential expenses in retirement. So advisors who can draw from these different tools are ultimately best positioned to have the most success and to satisfy their clients most meaningfully, meeting those clients where they are and providing a solution they're comfortable with. We do have software about this. This tool can be used within retirement income planning, and working particularly with clients, but particularly with prospects is where we're seeing some of the biggest successes. And if you haven't had a chance yet, please do feel free to take the RISA assessment yourself and see the report about your retirement income style.
Expand your opportunities at theamericancollege.edu.